At the Digital Asset Summit 2026, someone said something that should have been front-page news. Asset management is moving from $20 billion in vaults to $20 trillion on-chain. That is a 1,000x increase, and the timeline given was 12 to 24 months. The room did not laugh. Larry Fink nodded. Jamie Dimon nodded. The NYSE executive nodded. Nobody in that room said that's impossible. Think about what it means when the people who built the current financial system, the people with the most to lose from its replacement, are sitting in a room agreeing that everything they built is about to move somewhere else. That is not disruption. That is surrender. In real time, on stage, with cameras rolling. So if $20 trillion is moving on-chain in the next 12 to 24 months, and the people moving it are already in the room, why is XRP still priced as if none of this is happening? That gap between what is being built and what is being priced is the most important number in crypto right now. And today we're going to go through exactly what was said, word for word, by the people in that room. And then I'm going to explain precisely why the gap exists and what closes it. This is not financial advice. I am sharing publicly available information for educational purposes. Always do your own research. Before we get into it, drop 1000x in the comments if the scale of what was described at this summit hit you differently. Drop gap if the disconnect between the infrastructure being built and the current price is what's been frustrating you. I want to see which signal this community is focused on, because what I'm about to walk you through is the complete picture of what the most powerful people in finance just agreed to and why the price hasn't reflected it yet. Welcome back. I am the Calm Analyst. Around here, we don't react to headlines. We parse the exact language used by the people making the decisions. Today, we're breaking down the Digital Asset Summit 2026 statements, word by word, the $20 trillion migration thesis, the Swift composability layer, the privacy roadmap, and the precise three-component explanation for why the price hasn't moved. Let's get into it. Let me start with the statement that I think is the most important institutional claim made in public this year, and explain precisely why it deserves more analytical attention than it has received. An executive at the Digital Asset Summit stated that asset management is moving from $20 billion in on-chain vaults to $20 trillion, a 1,000x increase, with a timeline of 12 to 24 months. Let me put those numbers in context. The global ETF market currently manages approximately $30 trillion in total assets. The entire on-chain total value locked across all blockchains combined is measured in the hundreds of billions, less than 1% of the ETF market alone. The executive is describing a structural migration of the majority of managed assets from off-chain to on-chain infrastructure within 2 years. And this was said in a room that contained the leadership of Franklin Templeton, a firm with $1.7 trillion in assets under management. The NYSE, which has already announced a 24/7 tokenized securities platform, and Swift, whose chief innovation officer describes connecting to public and private blockchains as their primary strategic direction. And here is the data point that validates the direction, even if the timeline is aggressive. Franklin Templeton has already gone fully on-chain through its partnership with Ondo Finance. That is $1.7 trillion in institutional asset management capacity that has already made the structural decision, not evaluating, not waiting, committed. If 5% of the global ETF market transitions on-chain over the next 3 years, a conservative estimate offered by participants at the summit, that is $1.5 trillion in new on-chain capital from ETFs alone. Before tokenized real estate, tokenized bonds, tokenized commodities, or institutional DeFi are factored in. The 1000x is not a prediction. It is the arithmetic of where the decisions have already been made. If the scale of that commitment just reframed how you think about the current price, smash that like button. Because the gap between $20 trillion moving on-chain and XRP at $1.30 is the most important analytical signal in the entire market right now. Now let me give you the precise language that institutional participants used, because the specific words matter more than the summaries. The framing used was, if you can't beat them, join them. Credit card companies, commercial banks, entities that are directly competing with stablecoin businesses for the same revenue streams. These are not allies of the new financial system. They are competitors who have concluded that the cost of continued resistance is higher than the cost of adoption. That framing means the calculation has already been made at the executive level. The question for these institutions is no longer whether to adopt blockchain infrastructure. It is which blockchains, on what timeline, through which frameworks. On which blockchains, the specific framing was permissioned versus permissionless. With the acknowledgement that institutions will begin with more centralized permission solutions and progressively move toward credibly neutral, permissionless infrastructure as the technology and regulatory frameworks mature. This is not a detour around public blockchains. It is a staged pathway toward them. On privacy, one executive challenged the idea that institutions would move to fully transparent public chains. The response was that privacy layers on top of public blockchains are already being built. And the XRP Ledger specifically was noted as having privacy-adjacent tools already live, with full cryptographic privacy via the confidential MPT standard already in the development roadmap. On settlement, the specific model described was centralized matching in existing venues like the NYSE or Nasdaq with on-chain settlement. Not replacement of existing infrastructure, integration with it. Settlement happens on-chain. Everything else builds on top of what exists. The word used for this approach was composability, not replacement, not disruption, composability, connecting the new settlement locations to the existing infrastructure stack. Comment below. Which statement from the summit matters most to you? Type 1000x if it's the scale of migration. Type composability if it's the integration model. Type privacy if the XRP Ledger's privacy roadmap caught your attention. I want to see what this community is tracking. Now let me address the Swift development from this summit, because the specific language used by Swift's Chief Innovation Officer deserves precise analysis. He said, "We can now extend into new settlement locations like public and private blockchains. The blockchain we are putting on top of the Swift network, the whole idea is composability, so that we can connect to the new settlement locations that banks want to get to." Parse that carefully. Swift is not building a blockchain. Swift is building a composability layer, a connectivity framework that sits on top of the Swift network and allows it to connect to external settlement locations. The settlement locations are the blockchains. Swift is the bridge between the 11,000 banks it already connects and those settlement locations. He also said, "We can now integrate into the workflow new assets like tokenized deposits, stablecoins, and CBDCs, and we can extend into public and private blockchains." The word public is doing significant work in that sentence. Swift's Chief Innovation Officer, speaking at an institutional summit with cameras rolling, explicitly included public blockchains in the list of settlement locations Swift is building toward. The question for XRP holders is specific. When Swift builds this composability layer and connects to public blockchains, which public blockchains are already embedded in Swift's institutional ecosystem through certified partner relationships, shared banking clients, and active payment corridors? Ripple Treasury is a Swift certified partner. Approximately 30 of the 50-plus banks in Swift's new retail payments framework are documented Ripple partners. Thunes, ACI Worldwide, EastNets, and Finastra all provide indirect connectivity between Ripple's infrastructure and Swift's network. XRP does not need to be named in Swift's press release. It needs to be the settlement infrastructure that Swift's banking clients are already running on, and the documented evidence suggests it already is. Subscribe right now, hit the bell, drop a in the comments. Because the composability layer Swift is building connects to the blockchains that banks are already using, and we track every development in that convergence as it happens. Now let me answer the question that I've been building towards since the beginning, the question that the title raises, the question that every XRP holder asks when they check the price and see $1.30 after a week of the most significant institutional statements in crypto history. If the people who manage the world's financial assets are sitting in a room agreeing that everything is moving on-chain, if Franklin Templeton has committed $1.7 trillion, if Swift is explicitly building toward public blockchain connectivity, if the NYSE is launching 24/7 tokenized securities trading, if Bitwise is custodying 193 million XRP in its ETF vault, why is XRP priced as if none of this is happening? The answer has three components, and understanding all three is what allows the calm investor to hold through the current price environment with clarity rather than frustration. Component 1. The adoption curve lag. Every structural technology transition in financial history has followed the same pattern. The infrastructure gets built before it gets priced. The relationships get established before the volumes arrive. The partnerships get signed before the transactions begin. The smart money positions during the infrastructure phase. The price reflects the adoption phase, which comes later. We are currently in the infrastructure phase. The statements made at the Digital Asset Summit are infrastructure phase statements. They are commitments, directions, and frameworks, not live volumes. Live volumes come after the Clarity Act codifies the legal framework, after the trust bank charter pathways are established, after compliance departments and institutional allocators receive the legal green lights they require. Component 2. The macro compression. XRP's 0.80 correlation with Bitcoin means the macro environment, oil at $112, treasury yields at 4.5%, billions in options expiry mechanical selling, compresses the price independently of the fundamental development. The infrastructure thesis is intact. The macro is temporarily overriding it. Component 3. The distribution phase. Since XRP peaked at $3.65 in July 2025, an estimated $6 billion in tokens has been sold by large holders taking profits. This supply-side pressure adds consistent selling into a market that is already under macro headwind. These three components explain the gap. None of them represent a broken thesis. All of them are temporary, on different timescales, but temporary. The Clarity Act markup is scheduled for April. The Senate Banking Committee returns April 13th. The macro will normalize when the geopolitical situation resolves. The whale distribution will run its course, as it has in every previous cycle. When those conditions clear, simultaneously or sequentially, the gap between what is being built and what is being priced does not close gradually. It closes rapidly. Because the people in that room at the Digital Asset Summit are not waiting for permission to move. They have already decided. They are waiting for the legal framework that allows them to deploy at scale. That framework is weeks away from a committee vote. Let me leave you with this. The 1000x from $20 billion to $20 trillion. Stated on the record at the Digital Asset Summit 2026. Franklin Templeton's $1.7 trillion already committed on-chain. Swift's chief innovation officer explicitly naming public blockchains as new settlement locations. The NYSE launching 24/7 tokenized trading. Nasdaq targeting Q3 for tokenized stocks. The DTCC running tokenization pilots. 30 of 50 Swift framework banks already being Ripple partners, and the three-component explanation of why the price has not reflected any of it yet. The thesis is not in the price. That is not a problem. That is the opportunity. Because every week that the price stays disconnected from the infrastructure, the calm investor accumulates at prices that will not be available once the adoption phase begins. The gap between what is being built and what is being priced is temporary. The infrastructure is permanent, and the people who understand the difference between infrastructure phase pricing and adoption phase pricing are the ones who will be on the right side of the 1000x transition. Price is a distraction. Value is the reality. Structure is what matters. And the structure that was described, documented, and committed to at the Digital Asset Summit 2026 by the most powerful people in global finance is the most comprehensive validation of the on-chain thesis in the history of this market. In a market fueled by emotion and noise, we thrive on data and composure. Remember, haste leads to loss, while calm analysis leads to victory. If you made it to the end, you now have the complete Digital Asset Summit breakdown, the precise institutional language, the swift composability analysis, and the three-component framework that explains the gap. Comment "Calm Analyst" below. Let me see who stayed for the full picture. And share this with someone watching the price and concluding the thesis is broken. Because the thesis is not in the price yet. That is precisely the point. Like, subscribe, notifications on. I'll see you in the next one. Stay patient, stay rational. And as we always do, we don't wait for the future, we plan for it. Peace.